You may recollect from the video on Friday that we had discussed that if Nifty tests the 20 period moving average, a trader who's using a single time frame will take up a long position. For your reference, I have taken the price action to the 20 period moving average as of the closing on the Friday 7th. Here we will see that the 20 period moving average was at 22,443 and today's day low is at approximately 22,430, implying that if a blanket order was placed for Nifty at these levels, the trade would have triggered. In the same video, it was also discussed that our stop loss would be 1 ATR below the 50 period moving average, which yesterday was also at around 22,320. That is on Friday, the previous trade session, and approximately 22,240 was determined to be the SL. So as the day progressed, we can see that in the second half of the day, particularly towards the close, the market did create a low of 22,430, which will be visible here on this point. So you will note that the low is of 22,429.55 and the day close is at 22,460, wherein our order would have triggered at 22,443. And because these assessments are only done on the day, on paper we would have broken even if a blanket order of the 20 period moving average was placed. Let us now understand how a multi-time frame trader would have seen the same market. In this light blue line, which I will darken now, I have mentioned the start of the day, and in this other blue line, which I will maybe perhaps make it orange, I will mark it the point in the day when the indicator became highly oversold. So as mentioned, that in order to trade multi-time frames, we will make the assessment on the daily, and we are just reviewing the assessment that we made on Friday, that we were seeing a bullish crossover, and at the time ADX was much above 25, close to 29, and therefore the decision was to buy the call option, and the strike price at which we were going to buy was determined by the 50 period moving average minus the ATR. Sorry. So the point being that by placing these blanket orders, the single time frame trader definitely traded the day. Let us now understand how a multi-time frame trader would view it. So for a multi-time frame trader, once the trend has been assessed on the hourly chart, they would remove the trend filters, change the time frame to the 15-minute chart. That's largely because this is the time frame that is offered here. They would use an indicator called the RSI and simply change the input value to, let's say, for example, 4, since we are reducing the time frame by 4 units. And we will now, once I zoom in here, we will note that it is at around these levels that the market did become highly oversold on the 15-minute chart. That is, the more accurate first point for highly oversold would be here. That is, on the RSI setting of 4, we have identified that the market becomes oversold at this point on the 15-minute chart. Once this is done, we will remove all the indicators from the screen and simply focus on the 5-minute chart. That's largely because in this software that I'm using, I think a 3-minute time frame is not given, and nor is a 10-minute time frame. But if you were to assess it on the 10-minute time frame, you would simply change the RSI setting to 6 instead of 4. So coming back, once we have the orange line is marking the point on the 15-minute chart, which corresponds to this point on the 3-minute chart where the RSI became highly oversold. And now from this point, the trader is basically waiting for a higher top formation relative to the previous lower top. So for example, here where I'm marking with a horizontal line, and I will make this in another color, let's say for example orange, or maybe, yeah, I'll maybe mark it as pink. So in the pink line was the previous higher top that this trader was seeing at this time, and he is waiting for the break of this top on the 3-minute chart in order to take an entry. As it progressed, we see that there is no break. So now, once again, we will see that you would remember I had discussed the rule of 6. Rule of 6 means that if the high of a candle holds for 6 consecutive bars, it will be substituted as a pivotal high. This rule is something that, as I had mentioned in the previous video, I had drafted for myself while I was day trading, and of course the references are there on multiple books. But now we will see 1, 2, 3, 4, 5 and the 6th one. So in other words, the higher top reference now shifts from the previously identified value to this level, and the multi-time frame trader would still wait for the trade to trigger. And here we will see again the trade has not triggered, and rather we will note that the higher top has further shifted to this level here, because we have 1, 2, 3, 4, 5, and the sixth candle is formed, and this process continues. In other words, if you were trading using the single time frame method that was taught or explained in these videos, you would have triggered pretty much at the day low and closed break even. If you were using multi time frame trading, you would have tracked the market, and you would have started tracking the market after 1:30 p.m. and waited for a break, but you would have never got the break, and therefore you would have not traded the market at all. So with this, we understood how a trade plan that we formulated on a Friday, what is the impact of it when we approach the market on a Monday. Now let's make the trade plan for Tuesday. So once again, in order to make a trade plan for Tuesday, I will simply remove all these lines that are created here because I want a clear chart. And always, whenever I'm making a fresh trade plan, I always want to start by assessing the trend time frame the trend time frame, which for the purpose of intraday is definitely going to be the hourly chart, as we have discussed. In order to determine the plan, I will now use the trend indicators, which is the 20-50 period moving average, and make a quick note of what I'm observing. So here I'm observing that the slope of the faster MA, which reflects the momentum, is up. So the momentum is up, whereas the slope of the slower MA, which is reflective of the trend, is flat. In other words, on a primary glance, I can see that while the momentum of the market is still up, however, the trend is likely to range or be flat. So now, but we will continue with our mechanical process of assessment. That is, if there is a golden crossover is when the faster moving average is greater than the slower moving average. Then we will assume the trend to be up. In other words, even though I can see a flat moving average, I will still assume the trend to be up. But now the next corrective filter for the trend, and that is the simple ADX setting that we have. If ADX is greater than 25, then we will say there is a trend. If ADX is less than 20, then we will call it no trend or a range. So we will simply write it no trend, simply because we are not interested in trading ranges. Whereas if ADX is between 20 to 25, then we will not take a trade. There is no trade. So now that I have assessed, I have a fair idea of the momentum. I am expecting the market to be flattish based on the 50 MA, but there is a golden crossover which keeps me on the long side bias in the market. That is, I'm looking to buy the dip. If it's already trading below the 20 period, so this market is already in a potential support zone. But I need a confirmation now from ADX of whether or not I'm going to buy it, because if I'm going to buy it, then I know the step forward that this 50 period moving average, which is at roughly 22,325 or 320, minus the ATR, whatever will be the ATR, let us say it is 75 points. In that case, 22,250 is mostly going to be my long side SL. This part of the plan is already clear to me. The only thing that now remains to see is that if the ADX is meeting the criteria. So ADX criteria, if ADX is meeting the criteria for me to take the trade. So I will set the settings here, and I will remove the RSI since it is not required. And I will note that the ADX is actually at 24.97, which is below 25. In other words, I am not going to trade. I hope you have this clarity that we are using the hourly time frame simply to practice how to make a trade plan. In order to make a trade plan consistent, we are using consistent indicators. We will not be needing the ATR since our trade plan says that if ADX is between 20 to 25, there will be no trade. And what we have already discussed is the impact of the trade plan that we made on the Friday that it would have on us on a Monday. That is, once again, it would be a flattish day for us if we used a single time frame technique, and we wouldn't have got called into the trade at all despite following the market for 2 consecutive hours if we were using the multi time frame technique. And based on our assessment today, we are very clear that we are actually not going to trade to the market tomorrow. So yes, sometimes the whole point of making the analysis is the result of the analysis is no trade, and we just simply have to accept it. The question is what to do in case we keep coming at this no trade. Then the answer would obviously be assess more and more securities. You could repeat this process that you like. You could repeat it on securities such as Reliance, for example. Let's just add Reliance here and see. We are seeing a very strong bullish cross. We are seeing that there is a pullback. It is above the 20 period moving average. The ADX is also at 45. We know the moving average 50 period, which is at 1200. We know minus the ATR, that is if I simply add the ATR now, the ATR is 8 points, which means 1192 is going to be our SL. We already know these things now the minute we see this on Reliance. And the question is, what are we going to do? Are we going to buy at 1230 and 1200 with SL 1192? Or are we going to actively track Reliance during the day using the 15-minute and the 5-minute charts and determine if there is a legitimate breakout? This process is the idea of sharing these videos is, as I mentioned, not to give a call for Reliance to buy it at 1230 and 1200. It is simply to be used as a method of practice. And of course, there are a lot of ways in which you can make your assessment better. Still, this method, even though simple, will help you beat almost 98 or perhaps even 98.5 percentile traders in the country, because they are not even doing this much. So let your planning and preparation, that slight few minutes of planning and preparation before you enter a trade after the market, I'm very confident will be a huge edge against your competitors, which are your fellow traders in the market. With that, I wish you best for the remaining trade sessions.